In the world of finance, there are kings and there are shadows. The kings wear suits, appear on magazine covers, and run giant banks that everyone knows. But the shadows move silently. They bet against nations. They challenge the power of Wall Street. They win fortunes in silence and disappear before the crowd even knows what happened. These are the men who built hedge funds. Sebastian Mallaby's More Money Than God is not just a history of wealth. It is a story of rebellion inside capitalism itself. It tells how a few restless minds refused to follow the ordinary rules of investing. They looked at markets not as steady machines, but as living creatures full of emotion, greed, and fear. And in that chaos, they found opportunity. The story begins in the 1950s, when the financial world was calm and predictable. Big banks ruled with tradition. Government regulations drew hard lines. Everyone believed markets were efficient, that no one could beat them for long. Yet, somewhere in that quiet order, a few thinkers started asking dangerous questions. What if the market was not perfect? What if the crowd was often wrong? What if intelligence and courage could actually bend the system? From those questions, the hedge fund was born. It was not just a fund. It was a philosophy. The idea that you could make money whether markets went up or down. The belief that deep understanding and fast thinking mattered more than size or power. And the conviction that true investors were not gamblers. They were hunters of truth hidden inside the noise. This book traces that journey, from the early pioneers who experimented with strange new ideas to the masters who built empires on risk. It dives into the psychological wars fought inside trading rooms. It explores how hedge funds survived crises that destroyed others. And it shows how, even after decades of change, these secretive funds remain the sharpest edge of modern capitalism. As we move into the first part of the story, the pioneers, we meet the original thinkers who built the foundations of this hidden empire. They were mathematicians, philosophers, and mavericks. They trusted human judgment over blind models. They failed, learned, and rose again, creating a world where money was no longer about following rules, but about rewriting them. Next, we step into that beginning, into the laboratories of finance, where curiosity met courage, where ordinary men became legends, where hedge funds were not yet a global force, but just an idea waiting to explode. Part 1: The Pioneers. Every revolution begins with a question. And in the quiet halls of mid-century finance, a few minds began to question everything. Banks were strong. Markets were steady. Rules were clear. But these early thinkers saw cracks forming beneath the surface. They believed that hidden inside the logic of Wall Street was a deeper truth, one that could only be discovered by those brave enough to look beyond convention. This was the age before computers ruled trading floors. Every decision depended on human instinct. Investors followed charts, rumors, and gut feelings. Yet a handful of outsiders began to wonder if markets could be read like a story, if human behavior could be predicted, and if emotions, fear, greed, hope, could be measured and used to win. They were not billionaires yet. They were dreamers, teachers, and analysts working late nights with pencils and notebooks. They did not seek fame. They sought understanding. To them, the market was not a machine of numbers. It was a living organism that reacted to emotion, politics, and belief. These pioneers created the DNA of what later became the hedge fund industry. They designed ways to profit, not just when stocks rise, but also when they fall. They created strategies that seemed like magic to the outside world, turning volatility into opportunity and uncertainty into strength. But behind their genius lay something even more powerful: the human factor. It was not technology or algorithms that built the first hedge funds. It was people. People who trusted their minds more than the crowd. People who believed they could think their way through chaos. And that is where our story begins. With a man who watched markets not as a player, but as an observer of human nature. A man who believed that the secret of success lay not in the numbers themselves, but in understanding the emotions behind them. The next chapter reveals his journey. The story of how intuition, patience, and psychology built the foundation of modern investing. Chapter 1. The Human Factor. Before the age of algorithms and flashing computer screens, the market was ruled by human emotion. Every rise and fall in stock prices was a reflection of people, their fear, their greed, and their hope. In this uncertain world, one man stood out. His name was Alfred Winslow Jones. He was not a banker or a stock trader by training. He was a sociologist, a journalist, and a thinker who studied how people behave. And it was this understanding of human nature that gave birth to something extraordinary, the very first hedge fund. In the 1940s, Jones was writing for Fortune magazine. He observed that markets behaved like human crowds. They overreacted. They followed trends blindly. And they were driven more by psychology than by logic. He began to wonder, if one could understand these patterns, could one profit from them, regardless of whether the market was going up or down? That simple question changed financial history. Jones developed a bold idea. Instead of betting only on the rise of stocks like most investors, he would also bet on their fall. He combined two positions, long and short, into a single strategy. When he believed a company was strong, he bought its stock. When he believed another was weak, he sold it short. This way, no matter what happened to the overall market, he could still win. He called his approach hedging. It meant protecting himself from the storms of the market by balancing risk on both sides. But Jones did not stop there. He borrowed money to amplify his bets, increasing both potential profit and danger. This was financial innovation at its purest, a mix of logic, courage, and psychology. Jones's fund was small at first, just a few investors, a few $1,000s, and an experiment that few believed in. Yet, over time, his results shocked Wall Street. He consistently outperformed traditional funds. While others were crushed by market downturns, Jones's strategy allowed him to survive, and even thrive. His success was not built on technology or secret formulas. It came from understanding how people behave under pressure. Jones realized that fear makes investors sell too early, and greed makes them buy too late. He learned to stay calm when others panicked, and to question the crowd when everyone was confident. His fund became proof that intelligence and emotional control could be more powerful than size or fame. Soon, others tried to copy him, but few could master his balance between logic and instinct. To Jones, investing was not gambling. It was anthropology. He studied market behavior as if studying a tribe. He knew that behind every price movement was a story, a conflict, and a pattern of human desire. By the end of the 1950s, Jones had quietly built one of the best-performing funds in America. Yet, very few people even knew his name. He preferred it that way. His fund was not public, and his investors were private. It was a world built on trust, secrecy, and deep analysis, a world that would later explode into a global empire worth trillions. The true legacy of Alfred Winslow Jones was not just a clever financial model. It was a new way of thinking. He proved that success in markets depends not on predicting the future, but on understanding human behavior. His approach opened the door for a new generation of thinkers, people who saw the market as a battlefield of psychology rather than mathematics. From Jones's quiet experiment came the birth of the hedge fund industry. He became the invisible architect of a financial revolution. His work inspired future legends who would take his ideas further, mix them with science, and create some of the most powerful funds in history. And among those future minds was one man who would take Jones's vision to a new level. A trader who mastered aggression and precision, turning risk into an art form. Chapter 2. The Block Trader. The 1960s brought a new rhythm to Wall Street. The calm order of Alfred Winslow Jones's time began to shake under the pulse of ambition and speed. The world was changing fast. Television, jet travel, and global trade were connecting markets like never before. Into this restless era stepped a different kind of investor. He was not a philosopher like Jones. He was a fighter. His name was Michael Steinhardt. Steinhardt was the embodiment of intensity. Sharp eyes, relentless focus. A man who believed that hesitation was the enemy of profit. He did not wait for the world to make sense. He forced it to reveal its secrets. While Jones studied emotions and balance, Steinhardt studied information and speed. He built his fortune not by following trends, but by anticipating them, by seeing the move before it happened. He started small, trading in blocks of stocks that others were too cautious to touch. These were massive trades, the kind that could move markets in a single day. But Steinhardt had a talent few others possessed: the ability to read the hidden rhythm of supply and demand. He could sense when a large institution wanted to buy or sell, and he would position himself ahead of the move. He became known as the block trader, a man who could smell opportunity before the rest of Wall Street even looked up. Steinhardt's edge was built on information. He cultivated networks, brokers, traders, insiders, each feeding him pieces of the puzzle. He was not breaking rules, but he was walking the fine line between knowledge and advantage. Every trade was a test of nerve. Every decision demanded speed and confidence. His office was a battlefield of phones, paper, and tension. Yet, beneath his aggression lay a mind that respected discipline. Steinhardt believed that emotion was poison in the world of money. He demanded perfection from his team, sometimes pushing them to the edge of exhaustion. For him, investing was not just about numbers, it was about control. Control of mind, control of information, control of risk. He learned from Jones's principle of hedging, but gave it a sharper edge. He hedged positions not for safety, but for power, to free himself from market direction and focus purely on relative value. He was not content with surviving downturns. He wanted to dominate them. His fund, Steinhardt Partners, became a legend for its boldness. In some years, it earned returns that ordinary investors could only dream of. But Steinhardt's success came at a cost. The pressure of constant trading, the hunt for perfection, and the emotional toll of massive bets began to wear on him. Yet, he thrived in chaos. He once said that markets reward those who can stay rational when everyone else loses their mind. That philosophy made him one of the first true masters of hedge fund trading. His story represents the evolution of hedge funds from quiet experiments to aggressive engines of profit. Jones built the foundation. Steinhardt built the momentum. He proved that skill and discipline could bend markets, that confidence could become a weapon, and that timing could separate genius from ruin. By the end of the 1970s, Steinhardt had transformed the game. He showed that hedge funds were not just small, secret clubs of intellectuals. They could be powerful forces capable of moving billions. His strategies would inspire a new generation of traders who sought not balance, but domination. Yet, even as Steinhardt conquered the markets, another mind was watching from a distance. A thinker who believed that trading was not just science or aggression, it was philosophy. He would blend the logic of mathematics with the depth of human understanding, creating one of the most brilliant and mysterious hedge funds ever known. Chapter 3. The Philosopher King. While Michael Steinhardt stormed Wall Street with speed and aggression, another figure emerged who approached the market with a very different mind. His name was George Soros. Unlike Jones, who observed human nature, or Steinhardt, who relied on instinct and timing, Soros believed that the market itself was a reflection of the human mind. To him, markets were not just systems of money, they were systems of perception. And perception, he realized, was inherently flawed. Soros called his philosophy reflexivity. He argued that investors' biases and misconceptions could influence the market just as much as the market influenced them. Prices did not simply reflect reality, they shaped reality. When people acted on a belief, that belief changed the world they were acting upon. It was a loop, a cycle of perception and reaction, of expectation and disappointment. Understanding this cycle, Soros believed, was the key to extraordinary profit. He began his career in the 1950s in London, navigating a market still rigid and conservative. Yet Soros had a restless mind. He was fascinated by philosophy, particularly the ideas of Karl Popper, and he carried a notebook of observations wherever he went. Markets, he thought, were experiments in human behavior. He studied patterns, not just numbers. He observed mass psychology, herd behavior, and the emotional swings of traders. Every trade was an experiment, every loss a lesson. Soros's first hedge fund, which he launched in the early 1970s, applied these principles with precision. Unlike Jones, who sought balance, or Steinhardt, who sought speed, Soros sought truth, an understanding of how collective belief could drive prices far from their real value. His approach was unconventional. He would make large, sometimes audacious bets based on his analysis of market psychology, often against the prevailing consensus. One of his most famous early successes came from currency speculation. Soros observed patterns in exchange rates that others ignored. He understood that governments, institutions, and ordinary investors often acted on outdated or incomplete information. By anticipating these errors in perception, he could position his fund to profit immensely. His method was not mechanical. It required intuition, courage, and a willingness to stand alone against the crowd. Yet, Soros was not reckless. His genius lay in risk management. He hedged his bets, limited exposure when necessary, and studied every market with obsessive intensity. His philosophy blended aggression with caution, intuition with analysis. He became a master of timing, knowing when to strike and when to withdraw. In doing so, he created a fund that could survive shocks and thrive on chaos. By the 1980s, Soros had transformed the image of hedge funds. He was no longer just a trader. He was a thinker, a strategist, and a philosopher of finance. His approach showed that hedge funds could be more than machines for money. They could be laboratories for understanding human behavior, risk, and opportunity. Soros's story completes the first generation of hedge fund pioneers. From Jones's careful hedging to Steinhardt's relentless timing, and finally to Soros's philosophical mastery, we see the evolution of a new kind of investor, one who understands not just markets, but the human minds behind them. These pioneers laid the foundation. They proved that extraordinary returns were possible through intellect, courage, and insight. But the world was changing fast, and soon a new era would arrive, one of massive ambition, technological innovation, and global influence. Part 2. Masters of the Universe. By the 1980s, hedge funds had grown from quiet experiments into powerful engines of money and influence. The pioneers, Jones, Steinhardt, and Soros, had proven that skill, intuition, and understanding human behavior could bend markets. But a new generation was rising. These were not just investors, they were gladiators of finance, armed with speed, ambition, and access to a world that was growing larger and more complex by the day. The financial world was no longer a local stage. Globalization, deregulation, and technology created opportunities that had never existed before. Markets moved faster, capital flowed freer, and the stakes grew higher. In this new era, hedge funds became more than tools for profit. They became symbols of power. Their managers were now celebrities in the financial universe. They were the ones who could make fortunes overnight, influence governments, and shake entire economies with a single trade. These new masters of the universe built empires not just on insight, but on audacity. They perfected strategies, exploited inefficiencies, and learned to think in ways the ordinary investor could not. They combined psychology, mathematics, and sometimes sheer daring to create profits that seemed almost impossible. Risk was no longer something to avoid. It was something to master, to manipulate, and to weaponize. This part of the story introduces the stars of this era. They were bold, relentless, and often polarizing figures. Some were seen as geniuses, others as gamblers. But all shared a relentless drive to dominate markets on a scale the world had never seen. They built funds that became legends, shaping the global financial system as they grew. As we move into the first chapter of this part, we meet the alchemists of finance, investors who could turn chaos into opportunity and transform abstract theory into vast fortunes. Their strategies were bold, their personalities larger than life, and their impact undeniable. Chapter 4. The Alchemist. In the world of finance, some people do not simply follow trends, they create them. Among the new breed of hedge fund managers in the 1980s, one man stood apart as a master of transformation. His name was Julian Robertson. To those who watched him, Robertson seemed almost magical. He had a unique ability to see value where others saw only risk, to turn complex market signals into actionable insight, and to convert small bets into enormous gains. For this reason, his peers called him the Alchemist. Robertson began his career at Kidder Peabody, learning the mechanics of trading and investing. But he quickly realized that success in markets required more than technical knowledge. It required vision. The market was a living entity, and the alchemist's skill lay in understanding its hidden patterns. He could sense when a stock was overvalued, not because of spreadsheets, but because of subtle shifts in investor behavior, supply chains, or sentiment. He transformed information into foresight, foresight into strategy, and strategy into wealth. In 1982, Robertson launched Tiger Management, one of the first true modern hedge funds. From the start, his approach combined discipline with audacity. He would invest heavily in undervalued stocks, often taking large positions in companies that were ignored or misunderstood by the wider market. But he did not stop there. He constantly hedged positions, balancing risk against opportunity. Like an alchemist turning base metals into gold, Robertson could convert uncertainty into advantage. His fund quickly grew in reputation and size. Investors flocked to him, drawn not only by performance, but by his intellectual rigor. Robertson's methods were systematic yet flexible. He relied on fundamental analysis, studying companies in depth, but he also understood the emotional currents of the market. He knew that fear and greed drove prices more than logic, and he designed his strategies to exploit these patterns. Robertson also believed in mentorship. He recruited talented young analysts, teaching them the principles of discipline, analysis, and market intuition. Many of these protégés went on to become legends themselves, spreading Robertson's influence across the global financial landscape. His approach combined rigorous study with instinctive judgment, a rare combination that created a formidable edge. Yet, success did not come without challenges. Tiger Management faced moments of extreme market volatility, including crashes and sudden reversals. Robertson learned that to survive, a hedge fund must remain nimble, adaptable, and always aware of human psychology. His philosophy was simple. Fortune favors those who understand the world as it is, not as they wish it to be. Robertson's story shows that hedge funds were evolving from secretive experiments into forces capable of shaping global markets. They were no longer just vehicles for profit, they were instruments of influence. Managers like Robertson proved that intelligence, courage, and discipline could create not only wealth but also power. But while Robertson transformed chaos into opportunity, the market itself was becoming more complex and competitive. New figures emerged, each seeking to outperform the last, each testing the limits of risk and reward. The next legendary investor in our story challenged conventional wisdom even more boldly, often clashing with clients and critics alike, showing that the path to dominance was rarely smooth. Chapter 5: The Client's Always Wrong. In the evolving world of hedge funds, one truth became clear. Clients rarely understood the full complexity of the markets they invested in. They wanted safety, consistency, and reassurance. But the hedge fund world thrived on risk, insight, and occasionally contrarian thinking. Among the new generation of managers, one figure personified this tension: Paul Tudor Jones. He became known for his relentless trading acumen and his unshakable belief in the principle that the client is always wrong. Jones began trading in the 1970s with a singular focus: to understand patterns in markets and profit from them. Unlike traditional investors who followed fundamentals alone, Jones studied technical signals, charts, and historical cycles. He sought patterns in volatility, trends in fear, and repetition in human behavior. His ability to combine intuition with disciplined analysis gave him an edge few could match. One of Jones's defining traits was his respect for risk. He believed that no position should ever be taken without a clear exit strategy. Markets, he understood, were unpredictable, and ego could destroy fortune as easily as a sudden crash. His philosophy was that survival was the first priority, profit the second. In practice, this meant tight stops, quick adjustments and relentless monitoring of positions. Yet, Jones was not only disciplined, he was aggressive. He made bets that seemed reckless to outsiders, but each trade was calculated with meticulous care. When others panicked, he acted. When others hesitated, he seized opportunity. His most famous successes came from anticipating macroeconomic events, from currencies to commodities, often moving markets with the scale of his trades. But Jones's genius was not only in prediction, it was in psychology. He knew that clients, whether individuals or institutions, often demanded returns without understanding risk. They wanted to believe the market was controllable, that losses were mistakes rather than lessons. Jones embraced the opposite. He understood that markets punished arrogance and rewarded humility. This often meant contradicting client expectations, standing firm against pressure, and acting decisively even when unpopular. This approach made him both revered and feared. Investors who trusted his judgment prospered, while those who questioned him sometimes lost patience. Yet his results spoke for themselves. Over time, he established Tudor Investment Corporation as one of the most successful hedge funds of its era, producing extraordinary returns across multiple market cycles. Jones also understood that information was power. He built networks to track global developments, from economic reports to political shifts. He could anticipate reactions in markets before others even noticed signals. By combining analysis, instinct, and timing, he turned uncertainty into opportunity. The story of Paul Tudor Jones illustrates a critical lesson of hedge funds. Mastery requires independence from conventional wisdom and courage to act against the crowd. Profits come not from pleasing clients or following trends, but from understanding the psychology behind every price movement. Success is born of discipline, observation, and the willingness to challenge assumptions. Yet, even as Jones dominated markets with his insight, the hedge fund world was becoming more sophisticated. Technology, information, and strategy were advancing, and a new type of investor emerged, one who sought to contain risk within a precise framework, creating a box in which markets could be predicted, measured, and managed. This innovation would take hedge funds to an entirely new level of power and control. Chapter 6: The Box. By the late 1980s and early 1990s, hedge funds had evolved beyond intuition and instinct. They had entered a new phase, one dominated by systems, models, and precise control. Among the leaders of this era, one figure embodied this shift: Julian Robertson's protégés and contemporaries, who developed strategies designed to enclose markets within a conceptual framework, what insiders called the box. This approach combined mathematics, risk management, and strict rules to create a controlled environment where profits could be systematically pursued. The box was not a literal container. It was a philosophy, a disciplined way to manage risk, exposure, and opportunity. Hedge fund managers began to treat portfolios like engineered machines. Each position was analyzed not just for its potential profit, but for its interaction with every other holding. Diversification, correlation, and leverage were studied meticulously. This allowed funds to take bold positions without exposing themselves to catastrophic loss. A key figure in this evolution was Julian Robertson himself. Though he was known as the alchemist, Robertson understood that intuition alone could not sustain growth in increasingly complex markets. He began incorporating models that measured volatility, stress, and potential downside, effectively creating a safety net for his fund. This methodology allowed managers to dream bigger while controlling risk, giving them the freedom to exploit opportunities that others could not touch. Another pioneer of the box approach was Ed Thorpe, a mathematician who applied probability theory to markets. Thorpe's brilliance lay in transforming chaos into calculable patterns. He approached investing like a scientist, testing hypotheses, analyzing outcomes, and refining models continuously. His work laid the foundation for quantitative trading, which would later dominate hedge funds globally. Thorpe showed that finance could be approached systematically, using rules, data, and logic to capture profits consistently. The box philosophy changed the psychology of hedge funds. Managers no longer relied solely on gut feeling or luck. They built environments in which decisions were guided by precise measurements and disciplined protocols. Emotional bias was reduced, trades were calculated, risk was quantified. In effect, the unpredictable market became a playground of structured opportunity. Yet, the box was not foolproof. Human behavior, by its very nature, could not be fully contained. Market crashes, irrational exuberance, and sudden shocks proved that even the most sophisticated models had limits. Hedge fund managers learned that control was never absolute. It was a tool, not a guarantee. The lesson was clear. The better the framework, the more prepared you were. But survival still required vigilance, adaptability, and sometimes intuition. By mastering the box, this generation of hedge fund leaders became the first to combine mathematics, risk management, and strategy at scale. They turned investment into both science and art, creating profits that were larger, more consistent, and more repeatable than ever before. Hedge funds were no longer small experiments. They were institutions capable of moving markets and shaping global finance. This evolution set the stage for the next chapter of the story. As the box matured, so did the ambitions of the new hedge fund masters. They were no longer satisfied with understanding markets. They wanted to dominate them. They would use every tool, every insight, and every advantage to create funds so powerful that their influence extended far beyond Wall Street. Part 3. The Boom and the Bust. By the 1990s, hedge funds had become more than just powerful investment vehicles. They had become forces capable of shaping entire markets. The pioneers had laid the groundwork, and the masters had perfected strategy and control. Now the world was entering an era of extremes, unprecedented profits, unprecedented risks, and unprecedented consequences. The boom years of hedge funds were fueled by globalization, deregulation, and rapid innovation in finance. Funds grew larger, trades moved faster, and leverage magnified both gains and losses. Hedge fund managers had become celebrities, their fortunes headline news, their strategies studied and imitated. Yet, for every brilliant success, there was a lurking danger. A single miscalculation could erase billions, topple institutions, and ignite panic. This part of the story explores the high-stakes world where fortune and disaster lived side by side. It is a world of brilliant ideas and risky experiments, where short selling could yield massive profits and speculative bubbles could crumble overnight. It is a world that tested every lesson learned by hedge fund pioneers and masters: discipline, intuition, and understanding human behavior. As we enter this chapter, we focus on one of the most powerful tools in a hedge fund manager's arsenal: short selling. It is the art of betting against the market, of profiting when others fail. It requires courage, timing, and insight, because unlike traditional investing, mistakes can be devastating. Those who mastered it could turn fear into opportunity, turning a declining market into a path to enormous profit. The story now shifts to these daring strategies, the battles fought on global stages, and the lessons learned in triumph and disaster. Chapter 7. The Art of Short Selling. Short selling is one of the most misunderstood strategies in investing. To many, it seems counterintuitive or even reckless, betting that a company's stock will fall. Yet, for hedge fund managers, it became one of the most powerful tools for creating profit and controlling risk. It required more than courage. It demanded skill, timing, and an understanding of human psychology. Those who mastered short selling could profit not just when markets rose, but also when they fell. One of the early pioneers in this art was Michael Steinhardt. He had already made his name in trading blocks of stock, but short selling allowed him to exploit inefficiencies on a larger scale. Unlike conventional investors, who relied on hope and optimism, Steinhardt looked for weakness and overvaluation. He studied financial statements, industry trends, and investor behavior to identify targets that were vulnerable to decline. When others were confident, he acted. When others panicked, he avoided the trap. Short selling was not just about spotting weakness. It was about timing. Enter too early, and the market could recover, leading to loss. Enter too late, and the decline might already be priced in. Successful short sellers learn to observe patterns, anticipate reactions, and sometimes even influence sentiment. Hedge funds became adept at reading crowd psychology. A wave of fear or greed could be magnified and turned into profit, but only if approached carefully. George Soros also mastered short selling on a massive scale. His legendary bet against the British pound in 1992 demonstrated the extreme potential of this strategy. Soros recognized that the currency was overvalued due to political pressure and market expectation. He acted decisively, leveraging his position to the maximum allowed. When the Bank of England could no longer defend its currency, the pound collapsed. Soros's fund earned billions, proving that short selling, combined with insight into human perception, could change the course of entire economies. Short selling, however, was not without danger. Losses could be unlimited, and mistakes were magnified. Overconfidence, misreading data, or failing to anticipate unexpected interventions could destroy even the most sophisticated fund. Hedge fund managers learned the hard way that humility was as important as skill. Every short position required vigilance, discipline, and an escape plan. The art of short selling illustrates a broader truth about hedge funds. Success depends on seeing the world differently. It is not enough to follow the herd or assume the market is rational. Hedge fund managers must anticipate human error, act decisively, and often go against conventional wisdom. The rewards are enormous, but the risks are equally high. By mastering these principles, hedge funds thrived during the boom years, turning crises into opportunity and volatility into profit. Yet, the same forces that created fortune also set the stage for disaster. Overconfidence, leverage, and the relentless pursuit of alpha would eventually collide with reality, producing dramatic crashes and testing the resilience of even the most successful funds. As the story continues, we move from individual strategies to global battles, markets in turmoil, nations challenged, and hedge funds navigating a world that was becoming more interconnected and unpredictable by the day. Chapter 8: The Battle of Britain. The early 1990s brought a dramatic shift to global markets. Hedge funds were no longer confined to New York or the United States. They were reaching across oceans, influencing currencies, bonds, and equities worldwide. Among the most famous episodes of this era was the showdown known as the Battle of Britain, a moment when the power of hedge funds collided directly with government policy. George Soros was at the center of this story. By 1992, the British pound was under pressure. The United Kingdom had joined the European exchange rate mechanism, a system designed to stabilize currencies within Europe. But economic realities and market pressures made maintaining the pound's value increasingly difficult. Soros, with his deep understanding of reflexivity, observed that market sentiment and policy objectives were in conflict. He realized that the government could not indefinitely defend the currency at its overvalued level. Soros's strategy was precise and decisive. He borrowed massive amounts of pounds, converting them into other currencies with the expectation that the pound would fall. This was a classic application of short selling on a monumental scale. But it was also a test of nerves and strategy. The stakes were immense, the consequences global. Hedge funds like Soros's did not act recklessly. Each move was calculated, timed, and executed with careful attention to the unfolding economic and political landscape. The battle was not just financial, it was psychological. Traders, institutions, and governments watched closely, each trying to predict the next move. Soros's position placed immense pressure on the Bank of England. Central bankers attempted to intervene, buying pounds and raising interest rates, but the market was too strong, and expectations too entrenched. Eventually, the British government was forced to withdraw the pound from the exchange rate mechanism, allowing it to float freely. The currency collapsed, and Soros's fund made an estimated $1 billion in a single day. This event highlighted the extraordinary influence hedge funds had acquired. No longer were they merely participants in the market. They were players capable of shaping outcomes on a national and international scale. Soros's victory was not just about money. It was a demonstration of understanding markets as human constructs, influenced by belief, behavior, and perception. Yet, the story also exposed the risks inherent in such power. The pressure of managing massive positions, the scrutiny from governments and the media, and the ethical questions surrounding such influence created tension. Hedge fund managers were no longer invisible operators. They were public figures, admired by some and vilified by others. Every success invited closer examination. Every bold move carried potential consequences far beyond the trading floor. The Battle of Britain also inspired a new generation of hedge fund managers. They saw that insight, courage, and scale could yield unparalleled rewards, but they also saw that the stakes had never been higher. Markets were no longer isolated. They were connected, fast, and unforgiving. Profits could be vast, but mistakes could be catastrophic. As we move forward, hedge funds expanded their reach even further. They formed teams, leveraged global networks, and combined talent in ways that transformed the industry. The next chapter introduces one such team, whose collaboration, intellect, and ambition exemplified the height of the boom years, setting the stage for both extraordinary gains and looming challenges. Chapter 9. The Dream Team. As hedge funds grew in size, scope, and ambition during the 1990s, a new model of investing emerged, one built not just on individual brilliance, but on collaboration. This was the era of the Dream Team, a group of talented analysts, traders, and strategists who combined their skills to tackle the increasingly complex and interconnected world of global finance. Hedge funds were no longer one-person operations. They became carefully orchestrated machines, blending intellect, psychology, and mathematics. One of the most famous examples was Tiger Management under Julian Robertson. Robertson understood that the markets had become too vast and fast-moving for a single mind to master. He recruited young, intelligent traders, taught them his methods, and empowered them to develop their own strategies within the framework of his fund. These protégés were given both freedom and responsibility, creating a culture where creativity and discipline coexisted. The Dream Team concept was revolutionary. Each member contributed expertise: fundamental analysis, macroeconomic forecasting, technical modeling, risk management, or market psychology. Ideas were tested rigorously, debated intensely, and executed with precision. This environment created a multiplier effect. The collective intelligence of the team was greater than the sum of its parts. Trades became more sophisticated, risk was more carefully managed, and returns improved dramatically. The Dream Team model also fostered mentorship and innovation. Many of Robertson's protégés eventually left to start their own funds, carrying forward the knowledge and culture they had learned. This created a ripple effect across the hedge fund industry, spreading ideas and strategies at an unprecedented pace. Funds like these became incubators of talent and innovation, constantly evolving to stay ahead of competition. Risk was central to the Dream Team philosophy. They understood that high returns required exposure to uncertainty, but they also knew that uncalculated risk could destroy even the best strategy. Sophisticated hedging techniques, correlation analysis, and position sizing became essential tools. Every trade was scrutinized, every assumption questioned, and every decision backed by data and insight. The goal was not to eliminate risk, this was impossible, but to manage it intelligently. This era also highlighted the growing tension between ambition and humility. Hedge fund teams were making enormous profits, sometimes rivaling those of entire corporations, yet markets were inherently unpredictable. Hubris could destroy fortunes as quickly as poor analysis. The best teams survived by combining boldness with caution, intuition with discipline, and creativity with structure. The Dream Team approach fundamentally changed the culture of hedge funds. It demonstrated that collaboration, rigorous analysis, and disciplined execution could produce extraordinary results. Funds were no longer about a single genius. They were about systems of talent, ideas, and strategy working in unison. This model would dominate the boom years, propelling hedge funds to the forefront of global finance. Yet, even as these teams achieved unprecedented success, the world around them was becoming increasingly fragile. Bubbles were forming, leverage was rising, and volatility was intensifying. The very factors that had fueled extraordinary gains would soon test every assumption, every strategy, and every team. The next chapter explores how some hedge funds survived crises while others failed, and what separated the resilient from the vulnerable when the inevitable busts arrived. Chapter 10. The Survivors. The boom years of the 1990s created enormous wealth, but they also exposed a harsh reality. Not every hedge fund could survive the storms of the market. For every Tiger Management, Tudor, or Quantum fund that thrived, there were others that collapsed under the weight of leverage, misjudgment, or unforeseen crises. Survival in hedge funds was not just about skill. It was about resilience, adaptability, and the ability to learn from mistakes faster than the market punished you. The survivors shared several qualities. First, they understood that markets were unpredictable and often irrational. They knew that no strategy was infallible, and they built contingency plans to protect capital when the unexpected struck. Stop losses, hedges, and diversification were not optional. They were essential tools for endurance. These funds treated volatility not as an enemy, but as a feature to be navigated intelligently. Second, the survivors respected human behavior. They studied fear, greed, and crowd psychology as seriously as they studied balance sheets and earnings reports. They knew that panics could create opportunity, but only if approached with discipline and a clear plan. They avoided the trap of overconfidence, understanding that a string of successes could lull even the most brilliant managers into dangerous complacency. Third, the survivors cultivated culture and talent. Teams were carefully built, tested under pressure, and encouraged to challenge assumptions. Hedge funds like these became learning organizations where ideas were debated rigorously. Mistakes were dissected, and every member contributed to a collective edge. Human capital was as important as financial capital. The sharper the minds, the greater the chance of survival. Perhaps most importantly, the survivors mastered the delicate balance between risk and reward. Some took aggressive positions but hedged cleverly. Others embraced volatility but limited exposure to catastrophic loss. They recognized that leverage was a double-edged sword. It could multiply profits, but it could also destroy everything in a flash. Survival depended on respecting this force, understanding it, and controlling it with precision. The market crashes of the early 1990s and the volatility of emerging markets provided tests that separated the resilient from the vulnerable. Many funds that appeared brilliant on paper failed to survive sustained pressure. Others adapted, adjusted their models, and emerged even stronger. They learned that survival required humility, constant vigilance, and a willingness to evolve. George Soros's Quantum Fund exemplified these principles. Soros understood both opportunity and danger. His reflexivity theory was not just a method for predicting market moves, it was a philosophy for surviving them. By observing human behavior, anticipating reactions, and reacting decisively, he navigated crashes that would have destroyed less disciplined funds. His survival and extraordinary success came from combining insight, agility, and calculated risk. The lesson of the survivors was clear. Talent alone was insufficient. Intelligence alone could not guarantee success. Survival required systems, strategy, psychology, and above all, the ability to endure. Hedge funds were powerful, but they were also fragile. Their triumphs and failures were extreme, and only those who respected both the power and the peril could endure. As we move into the next phase of this story, the hedge fund world was about to confront an entirely new landscape, one where size, strategy, and global ambition defined the next elite. The survivors had proven what worked, but the future demanded innovation on a larger, more daring scale. Part 4. The New Elite. By the early 21st century, hedge funds had evolved once again. No longer were they experimental ventures or boutique operations run by a single genius or a tight-knit team. They had become global powerhouses, commanding billions of dollars, influencing markets, and shaping economies. The survivors of previous booms and busts had given way to a new elite, managers who combined intellect, scale, and audacity to dominate on an unprecedented level. These leaders were more than investors. They were strategists, thinkers, and sometimes visionaries who understood that success in modern finance required a blend of psychology, data, technology, and timing. They mastered complexity, anticipating not just markets, but the reactions of governments, institutions, and even their peers. They were no longer just participants. They were architects of the financial system itself. The new elite also represented a generational shift. They leveraged lessons from the pioneers, the masters, and the survivors, but they added innovation and scale. Risk was no longer just managed. It was engineered. Opportunity was no longer discovered. It was created. They operated with a level of sophistication and global reach that transformed hedge funds into institutions of immense influence. As we enter this chapter, we focus on one of the most iconic figures of this era, a man whose understanding of markets, strategy, and human behavior was so profound that he seemed to know the outcome before others even began to act. His story illustrates how the hedge fund industry had matured, and how the combination of insight, scale, and audacity defined the new elite. Chapter 11. The Man Who Knew Too Much. In the world of hedge funds, some investors see patterns where others see chaos. Among the new elite, there emerged a figure whose reputation for insight was almost legendary. He seemed to possess an uncanny ability to anticipate market movements, to understand the interplay of global events, and to act decisively before anyone else recognized the implications. To many, he was known as the man who knew too much. This investor was Ray Dalio, the founder of Bridgewater Associates. Dalio approached markets with the mindset of a scientist. He believed that economic systems could be understood through principles, patterns, and cause and effect relationships. Yet, he also acknowledged the limits of prediction. Unlike many who relied on intuition alone, Dalio combined rigorous analysis with systematic modeling, creating an approach that was both disciplined and adaptable. Dalio's philosophy was rooted in radical transparency and open debate. He built Bridgewater as an organization where ideas were constantly challenged, and decisions were made based on merit rather than hierarchy. Meetings were intense, arguments were frequent, and no opinion was beyond scrutiny. This culture of intellectual rigor allowed the firm to identify risks and opportunities that others overlooked. One of Dalio's key innovations was his use of risk parity and other quantitative strategies to manage exposure across asset classes. By balancing risk rather than just capital, he could navigate volatility and protect the fund during market turbulence. This approach reflected a deep understanding that markets are interconnected and that diversification, if done intelligently, could mitigate losses while preserving the potential for gain. Dalio also studied history obsessively. He analyzed previous market cycles, financial crises, and economic trends to develop principles that could guide decision-making. His approach was holistic. He combined macroeconomic insight, data analysis, and human psychology to create a framework that was remarkably resilient across different market conditions. Yet, even with all his preparation, Dalio recognized the unpredictable nature of markets. He treated every investment as a hypothesis, tested by reality. Losses were lessons, and the process of continual learning became central to his strategy. By embracing uncertainty rather than fearing it, he turned complexity into advantage and chaos into opportunity. The man who knew too much exemplifies the new era of hedge funds. Scale, intelligence, and global perspective combined with systematic discipline. Success was no longer about instinct alone. It was about building systems, cultivating talent, and mastering both data and human behavior. Dalio's influence extended beyond profit. His principles and methods became a model for the next generation of hedge fund managers, setting a new standard for what was possible in modern finance. As we move forward, the story shifts to another critical innovation in the hedge fund world: the concept of the anti-bubble. It represents a shift in thinking, managing not only risk and opportunity, but also preparing for the rare, extreme events that can redefine markets and fortunes alike. Chapter 12. The Anti-Bubble. By the early 21st century, the hedge fund industry had grown in sophistication, scale, and influence, but it also faced a new challenge: extreme events that defied conventional analysis. Financial crises, asset bubbles, and global shocks demonstrated that traditional risk management was often insufficient. In response, a new philosophy emerged among the elite, what some called the anti-bubble. This approach sought not just to navigate markets, but to anticipate and profit from extreme dislocations, market panics, and irrational exuberance. The anti-bubble concept was pioneered by managers who understood that the majority of market losses occur not in ordinary fluctuations, but during rare, severe events. They realized that conventional diversification or hedging might not be enough to survive crashes. Instead, the anti-bubble approach combined preparation, scenario planning, and strategic contrarianism to thrive when others were paralyzed by fear. One of the best examples of this philosophy was Nassim Nicholas Taleb's influence on hedge funds and risk management. Taleb highlighted the danger of underestimating rare but catastrophic events, which he called black swans. Anti-bubble managers absorbed this lesson. Markets are not linear, predictions are often flawed, and extreme events are inevitable. The key was not to avoid these events, but to structure investments so that the fund could survive and even profit when they occurred. Ray Dalio and Bridgewater Associates were also at the forefront of anti-bubble thinking. Dalio developed strategies to stress test portfolios against hypothetical crises, simulating economic shocks, currency collapses, and debt defaults. By modeling extreme conditions, he created systems that could withstand severe turbulence, giving his fund both resilience and opportunity. When other funds were forced to liquidate or panic, anti-bubble managers were prepared to act decisively. The anti-bubble philosophy extended beyond mathematics and stress testing. It required psychological fortitude. Hedge fund managers had to remain calm when markets panicked, disciplined when everyone else capitulated, and flexible when patterns broke down. They cultivated the ability to see opportunity in fear and value in chaos. For many, this meant betting against consensus at precisely the moment when the herd was overextended. Importantly, the anti-bubble mindset reshaped the culture of hedge funds. Teams became more analytical, discussions more rigorous, and contingency planning central to decision-making. Success was no longer measured solely by gains during bull markets, but by survival and performance during crises. This approach created a new benchmark: the ability to prosper under conditions where most investors failed. The anti-bubble era also illustrated the growing influence of hedge funds on global finance. Funds that anticipated crises could sway markets, affect currencies, and challenge government policies. They were not passive participants. They were active players, capable of turning systemic stress into opportunity. The lessons of anti-bubble thinking remain critical. In a complex, interconnected world, preparation, insight, and discipline are as important as speed, intelligence, and ambition. As we move forward, hedge funds faced questions about their own future. Could this new elite continue to dominate? Could innovation keep pace with risk? The answers would shape the next generation of managers and the evolution of the industry. Chapter 13: The Future of Hedge Funds. As the 21st century progressed, hedge funds were no longer secretive operations or niche experiments. They had become central players in global finance. The pioneers, the masters, and the survivors had all paved the way, but the industry now faced a new set of challenges and opportunities. The future of hedge funds depended on innovation, adaptability, and the ability to navigate an increasingly complex and interconnected world. Technology was transforming the landscape. Quantitative models, high-frequency trading, and algorithmic strategies allowed funds to process vast amounts of information in real time. Computers could analyze market data faster than any human, uncover hidden patterns, and execute trades in milliseconds. This increased efficiency created opportunities for enormous profits, but also raised the stakes, as errors could be amplified and competition intensified. Hedge funds now required a blend of human judgment and technological sophistication to maintain an edge. Globalization further complicated the future. Markets were no longer isolated. Shocks in one country could ripple across continents within hours. Hedge fund managers needed to understand macroeconomics, political developments, and regulatory changes on a global scale. The ability to anticipate cross-border events became a critical skill, and funds expanded their reach. hiring analysts and strategists from around the world to provide insight into emerging risks and opportunities. The future of hedge funds also required a new approach to risk management. The lessons of past crises, from the boom and bust cycles to the anti-bubble strategies, remained relevant. Managers had to combine rigorous quantitative analysis with psychological insight, ensuring that portfolios could withstand both predictable and unforeseen shocks. The ability to survive extreme events and even profit from them became a defining characteristic of successful funds. Culture and talent were equally important. Hedge funds that thrived invested in people as much as capital. Teams were built to encourage debate, challenge assumptions, and foster innovation. The best managers recognized that ideas could come from anyone, and that an environment of transparency and rigorous analysis produced a sustainable competitive advantage. Mentorship, collaboration, and disciplined execution remained central to long-term success. Ethics and regulation also shaped the future. Hedge funds wielded enormous influence, and their actions could affect markets, investors, and even entire economies. Increasing scrutiny from regulators and the public meant that transparency, compliance, and responsible management became essential. The industry faced the challenge of balancing ambition and profit with accountability and sustainability. Despite the challenges, the potential for hedge funds remained vast. Innovation, insight, and adaptability allowed them to create extraordinary value, seize opportunity where others hesitated, and navigate complexity with skill. The future belonged to those who could combine lessons from the past with vision, courage, and discipline. Hedge funds would continue to evolve, but their essence remained the same: a relentless pursuit of understanding markets, human behavior, and risk, and the ability to act decisively where others could not. The story of hedge funds, from the early pioneers to the new elite, illustrates both the potential and peril of the industry. The final reflection is on what gives certain funds their enduring edge: principles, strategy, talent, and the courage to think differently. Epilogue: The enduring edge. Hedge funds have always been defined by the tension between opportunity and risk. From the earliest pioneers experimenting in small offices to the global elite commanding billions, the story of hedge funds is the story of human ingenuity, ambition, and adaptability. What sets the most successful funds apart is not luck, nor is it brute force. It is the enduring edge, a combination of insight, discipline, and the ability to act decisively when others hesitate. The enduring edge begins with principles. The greatest hedge fund managers develop a framework for decision-making, grounded in observation, analysis, and experience. They do not rely solely on instinct or intuition, though both play a role. They study markets, human behavior, and history, seeking patterns and lessons that can be applied consistently. This systematic approach allows them to navigate complexity and uncertainty with confidence. Discipline is the second pillar. Markets are unpredictable, and emotions are constant. Successful hedge fund managers maintain composure in the face of volatility, adhering to their strategies while remaining flexible enough to adjust when circumstances change. They know when to act and when to wait, when to take risk and when to protect capital. Discipline turns intelligence into results, ensuring that insight translates into performance over the long term. Talent and culture form the third component. Hedge funds are not the work of a single individual. They are built on teams of exceptional thinkers, analysts, and traders. Collaboration, debate, and mentorship create a culture where ideas are tested, refined, and implemented. The best funds harness collective intelligence, recognizing that a diverse set of perspectives produces stronger decisions and sustainable advantage. Finally, the enduring edge comes from courage, the willingness to act against conventional wisdom, to anticipate shifts before others, and to take calculated risks when opportunity arises. Hedge funds thrive on asymmetry, the ability to gain from insights that others fail to see, to turn chaos into advantage, and to profit where others fear to tread. Courage is tempered by knowledge, analysis, and experience, creating a balance between boldness and prudence. The history of hedge funds demonstrates that success is neither accidental nor guaranteed. Pioneers blazed the trail, masters expanded the boundaries, Survivors navigated crises, and the new elite harnessed scale, technology, and strategy to dominate markets. Across generations, the common thread has been the pursuit of understanding and the disciplined application of insight. For investors, managers, and students of finance, the lessons are clear. Study carefully, act decisively, manage risk intelligently, and never underestimate the power of human behavior. Markets will always reward preparation, adaptability, and the ability to see what others cannot. Hedge funds may change in form, scale, and strategy, but the principles that create lasting success remain constant. The enduring edge is more than a strategy. It is a mindset. It is the drive to understand, to anticipate, and to execute where others hesitate. It is what separates the leaders from the followers, the innovators from the imitators, and the legends from the forgotten. In a world defined by uncertainty, the enduring edge ensures that hedge funds continue to thrive, shaping markets, creating wealth, and defining the future of global finance. If you enjoyed this deep dive into More Money Than God and want more audiobook-style summaries of top finance and investing books, make sure to subscribe now. Stay updated with new chapters, insights, and stories that can transform the way you think about money, markets, and success. Hit the subscribe button and never miss an edge in finance.